Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Freedom Holdings Corp. Quarterly Report. Freedom Holding Corp. offers a diverse range of services to its clients. At the core of their business are securities brokerage and trading services, which include retail and commercial banking, investment research, and counseling. They provide various financial products such as exchange-traded and over-the-counter corporate equity and debt securities, money market instruments, government bonds, and mutual funds. In addition to these services, Freedom Holding Corp. offers a range of banking solutions including payment cards, digital mortgages, and digital business, and auto loans through their Freedom Box package. They also provide capital raising solutions for corporate clients through initial public offerings and follow-on offerings, as well as debt capital market solutions that focus on structuring and distributing private and public debt. The company's services extend to proprietary trading and investment activities, including repurchase and reverse repurchase agreements, short position coverage, and settlement of securities obligations. They also offer a software platform called Tradernet for client margin risk evaluation and middle office security transfer requests. With operations in Kazakhstan, Armenia, Cyprus, the United States, and internationally, Freedom Holding Corp. is a global financial services provider. Freedom Holding Corp's stock price has experienced a significant decline of over -18.5% in the past year, with a notable drop following its FY 2025 earnings report. The company's net income plummeted due to strategic spending on customer acquisition, causing some investors to be spooked. This was followed by lower profitability in Q3 FY 2026, attributed to higher operating expenses and decreased revenue. The decline in Freedom Holding Corp's stock price can also be attributed to declining margins and financial health concerns. The company's operating and gross margins have shown signs of long-term decline, raising concerns about its financial sustainability. Additionally, the ongoing issuance of debt totaling $1.1 billion over the past 3 years presents a significant financial risk. Geopolitical risks in the regions where Freedom Holding Corp. operates also pose a threat to the business. Ongoing geopolitical factors in Kazakhstan and Russia could materially and adversely affect the company's operations, further contributing to its declining stock price. Freedom Holdings Corp. market capitalization of $7 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Freedom Holdings Corp. holds a significant advantage in their industry. Freedom Holdings Corp. trades at a higher price-to-earnings ratio of 17.45 times, and a higher price-to-book ratio of 5.36 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. As this company belongs to the financial conglomerates industry, the liability ratio is less meaningful for valuation. Investors should instead focus on return on assets, ROA, and return on equity, ROE, to better assess the company intrinsic value. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, an increase in retail brokerage customers has led to higher revenue from brokerage services. Additionally, increased activity and improved volumes have resulted in higher revenue from underwriting and market-making services. Furthermore, interest income on loans to customers, margin loans, securities available for sale, and held-to-maturity securities has also seen a significant increase. Agency fee income has also contributed to the growth. On the other hand, revenue decline can be attributed to several factors. A decrease in fee and commission income from payment processing due to lower average acquiring rate and transaction turnover has been a major contributor. The cashback-based loyalty program usage has driven down banking services revenue significantly. Moreover, a realized gain offset by an unrealized loss on trading securities has resulted in a net decline in revenue. Insurance premiums earned have also seen a decrease. The company's financial performance is further impacted by various other factors. An increase in cost of sales, payroll and bonuses, professional services, and stock compensation expense has put pressure on the bottom line. Foreign currency translation losses have also increased, contributing to the overall decline in net income. Exchange rate fluctuations resulting in a loss and trading securities resulting in a loss have further exacerbated the situation. However, equity investments have resulted in a gain, providing some respite from the decline. The net income and profit margins of the company underwent significant changes between 2024 and 2025. For the 3 months ended December 31, 2025, the net income decreased by 3% to $76,235 compared to $78,137 in the previous year. However, for the 9 months ended December 31, 2025, the net income plummeted by a staggering 36% to $145,352 from $226,884. The profit margins also suffered a decline, with the net income margin decreasing from 11.7% in 2024 to 12.1% in 2025 for the 3 months ended December 31. For the 9 months ended December 31, the net income margin dropped dramatically from 13.3% in 2024 to 8.6% in 2025. The reasons behind these changes are multifaceted. The company experienced an increase in operating expenses, including depreciation and amortization, stock compensation expense, and a decrease in unrealized gain on trading securities. Additionally, the effective tax rate rose from 15.5% in 2024 to 25.4% in 2025, with an extra 10% applied to corporate income tax rate on certain types of income in Kazakhstan. These factors collectively contributed to the decline in net income and profit margins. The company's financial performance in 2025 indicates a significant improvement in its ability to generate cash from its core operations. The net cash flows from operating activities have increased substantially, rising from $343,311 in 2024 to $1,733,896 in 2025. This increase is also reflected in the net change in cash and cash equivalents, which has grown from $312,372 in 2024 to $1,867,772 in 2025. The confirmation on page 107 that operating cash flow positive further supports this conclusion. The company's ability to generate positive operating cash flow is a crucial indicator of its financial health and stability. It suggests that the company has sufficient resources to meet its short-term obligations and invest in its growth initiatives. Overall, the data indicates that the company is on a solid footing financially, with a strong capacity to generate cash from its core operations. The company's debt level and interest expenses have undergone significant changes in recent years. The total debt level has seen a substantial increase from $469,551 in March 2025 to $1,075,397 in December 2025, indicating a notable rise in the company's financial obligations. However, the interest expenses have shown mixed trends. On one hand, the overall interest expense decreased by $3.2 million, minus 2%, and $57,935, 14%, from 2024 to 2025, suggesting some cost savings for the company. On the other hand, there was a significant increase in interest expenses of $37.4 million in the other segment. The breakdown of interest expenses reveals that securities repurchase agreement obligations saw a decrease due to lower average balances and market risk exposure, while customer liabilities experienced an increase due to growth in customer deposits. Additionally, debt securities issued resulted in higher interest expenses due to new placements. These mixed trends indicate that while the company's overall interest expenses have decreased, certain segments have seen significant increases, highlighting the need for closer examination of its financial obligations and interest expense management strategies. The performance of various segments within the company has been mixed. On a positive note, the banking segment saw a significant increase in revenue, with a 14% boost. The brokerage and insurance segments also showed promising results, with net incomes of $51,639 and $23,402 respectively. However, some segments struggled to keep pace. The other category incurred a substantial net loss of $105,731. Furthermore, the brokerage segment experienced a decline in revenue, with a 2% decrease. The insurance segment fared even worse, with a staggering 34% drop in revenue. These underperforming segments will require attention and improvement strategies to get back on track. Management's outlook on the company's strategy is centered around growth and innovation. The group aims to act as a seamless agent for its customers, enabling them to enter into various financial services through a single interface, known as the Super App. This ecosystem delivers multiple financial services, including payment processing and IT infrastructure provision, which are driving revenue growth. The company is pursuing an aggressive growth strategy, both organically and through acquisitions, with the goal of expanding its offerings and increasing market share. While current cash reserves are sufficient to meet immediate needs, management anticipates that additional capital resources may be required for future growth, potentially through external equity or debt financing. In terms of risk management, the company's primary objective is to preserve capital and support liquidity requirements through prudent investment policies. This focus on minimizing potential risk of principal loss underscores the importance of careful financial planning and management in achieving long-term success. The company has made significant moves through its acquisitions and divestitures strategy. In terms of acquisitions, one notable example is the purchase of equipment and software from Freedom Telecom Operations Limited. This acquisition likely aimed to enhance the company's operational capabilities and expand its offerings. On the other hand, the company has also engaged in strategic divestitures. One such instance was the sale of its Russian subsidiaries in February 2023. This move may have been a response to changing market conditions or regulatory requirements, allowing the company to focus on more profitable ventures. The company's financial history reveals a consistent practice of distributing profits to its shareholders. As stated on page 88, the payment of cash dividends is indeed affirmative. This indicates that the company prioritizes returning value to its investors through dividend payments. And that concludes the financial summary for Freedom Holdings Corp. Feel free to comment below, and I will be happy to answer them when possible.